Ladies and gentlemen, what if the biggest news from the Federal Reserve isn't about interest rates at all? What if it's revealing something much bigger about the future of the global financial system? While most people focus on headlines and daily market swings, experienced investors pay attention to liquidity, credit conditions, and the flow of capital. Those forces shape every major asset, including gold and silver. If you own precious metals, or you're thinking about buying them, you need to understand what the Fed's latest signals could mean, not just for prices tomorrow, but for protecting wealth over the next decade. Let's break down what really matters. When people hear about a Federal Reserve announcement, they usually focus on one number. Was there a rate cut or rate hike? Did policymakers sound optimistic or cautious? Those details matter, but they're only a small part of a much larger picture. The real question isn't what was said during a press conference. The real question is what the broader policy direction tells us about liquidity, capital allocation, and financial conditions across the global economy. Markets function on liquidity. Every major asset class, whether it's equities, bonds, real estate, commodities, or precious metals, responds to the availability and cost of capital over time. When liquidity expands, investors tend to take on more risk, businesses find financing more accessible, and economic activity often accelerates. When liquidity contracts, priorities change, capital becomes more selective, borrowing costs matter more, and investors begin paying closer attention to preserving purchasing power instead of simply maximizing returns. This is why experienced market participants spend more time studying financial conditions than reacting to headlines. The daily news cycle is designed to capture attention, but successful investing has always required separating short-term noise from long-term structural change. Markets rarely move because of a single event. They move because countless decisions across banks, businesses, institutions, and governments gradually reshape the flow of capital. Liquidity influences confidence. Confidence influences investment decisions determine where capital ultimately settles. Understanding this chain of events provides a clearer framework for evaluating markets than attempting to predict every short-term price movement. Periods of abundant liquidity often create an environment where investors become increasingly comfortable taking risks. Valuations expand, optimism grows, and capital searches aggressively for higher returns. History shows this pattern repeatedly, but every cycle eventually reaches a point where financial conditions become more restrictive. At that stage, discipline becomes more valuable than enthusiasm. That transition is where sophisticated investors begin asking different questions. Instead of wondering which asset might deliver the highest return next month, they ask which assets are positioned to preserve value through multiple economic scenarios. This shift in thinking reflects experience rather than emotion. Financial markets are interconnected in ways that aren't always obvious. Changes in credit availability affect corporate investment. Corporate investment influences employment. Employment shapes consumer spending. Consumer spending impacts business earnings. Those earnings affect equity markets, credit markets, and broader investor confidence. None of these developments occur in isolation. Every adjustment creates ripple effects that extend throughout the financial system. The global economy has also become increasingly interconnected. Capital moves across borders at extraordinary speed. Decisions made in one major financial center influence borrowing costs, investment strategies, and currency markets around the world. Institutional investors constantly evaluate these relationships because understanding them provides an advantage that goes far beyond interpreting a single economic report. One of the biggest mistakes investors make is assuming that every market move requires immediate action. Often the opposite is true. Successful investing frequently rewards patience, preparation, and disciplined execution more than constant activity. Markets naturally fluctuate, but long-term wealth is generally built by making thoughtful decisions rather than emotional ones. This is especially important during periods of uncertainty. Uncertainty isn't unusual. In fact, uncertainty is one of the few constants in financial markets. Every decade presents different challenges, different risks, and different opportunities. What separates durable investment strategies from speculative ones is their ability to withstand changing economic environments instead of relying on perfect forecasts. Investors who focus exclusively on price often overlook the underlying forces driving those prices. Capital flows, credit conditions, productivity, fiscal policy, demographic trends, and global trade all contribute to the environment in which assets perform. Looking at only the final price movement without understanding these drivers is like reading the final page of a book without knowing the story that came before it. Risk management deserves equal attention. Preserving capital during difficult periods creates flexibility when opportunities eventually emerge. Investors who remain financially resilient can make rational decisions while others are forced into reactive ones. That advantage compounds over time. Diversification also becomes increasingly important as economic conditions evolve. No single asset performs best under every circumstance. Strong portfolios are designed with multiple scenarios in mind rather than a single prediction about the future. This mindset recognizes that uncertainty cannot be eliminated, but it can be managed through thoughtful allocation and disciplined planning. The financial system rewards those who respect complexity. Economic cycles are influenced by policy decisions, technological innovation, consumer behavior, geopolitical developments, and countless variables that cannot be perfectly predicted. Accepting this reality encourages humility, which is one of the most valuable qualities any investor can possess. Rather than searching for certainty, experienced investors seek resilience. They build portfolios capable of navigating changing environments because they understand that markets will always experience periods of optimism and periods of caution. Neither lasts forever. Ultimately, long-term success isn't determined by who reacts fastest to every headline. It's determined by who understands the broader forces shaping the movement of capital, who manages risk consistently, and who remains committed to disciplined decision-making despite temporary volatility. Financial markets will continue to evolve, policies will continue to change, and economic cycles will continue to unfold. Those realities are unavoidable. The opportunity lies in recognizing that liquidity, capital allocation, and financial discipline often tell a much more important story than the headlines that dominate any single day. Investors who keep their attention on those enduring fundamentals place themselves in a stronger position to navigate uncertainty while protecting and growing wealth over the long run. Most investors spend their time watching prices. They monitor charts, react to breaking news, and search for the next market-moving headline. Yet the largest shifts in financial history rarely begin with dramatic price movements. They begin with gradual changes in the structure of the global economy, changes in capital flows, government policy, international trade, debt levels, and institutional investment behavior. By the time those shifts become obvious to everyone, much of the opportunity is already past. This is why experienced investors spend less time trying to predict tomorrow's market move and more time understanding the long-term direction of the financial system. Markets are ultimately a reflection of confidence, liquidity, productivity, and economic incentives. Prices simply represent the visible result of forces that have often been building quietly for years. Today's economic environment illustrates this principle. Around the world, governments continue managing historically high debt burdens while balancing economic growth, inflation, fiscal spending, and financial stability. Central banks face difficult trade-offs. Businesses continue adapting to higher financing costs, evolving supply chains, technological disruption, and changing consumer behavior. At the same time, institutional investors are constantly reassessing how they allocate capital across different regions and asset classes. These developments are interconnected. They don't happen independently, and they don't produce immediate results overnight. Instead, they gradually reshape the global financial landscape, influencing investment decisions long before those changes are reflected in market prices. Global capital has become remarkably mobile. Large pension funds, sovereign wealth funds, insurance companies, banks, and multinational corporations continuously evaluate where capital can be deployed most efficiently, while balancing expected returns against risk. Their decisions influence currencies, bond markets, equities, commodities, and virtually every corner of the financial system. When institutional capital begins adjusting its long-term priorities, those changes tend to unfold over many years rather than a few trading sessions. Investors who understand these structural trends are generally better positioned than those who react solely to daily headlines. Another important factor is confidence. Financial systems depend heavily on confidence because modern economies are built upon credit, investment, and expectations about the future. Businesses hire because they believe future demand will justify expansion. Consumers spend because they expect stable income. Financial institutions extend credit because they have confidence in borrowers and broader economic conditions. When confidence strengthens, economic activity usually accelerates. When confidence weakens, capital becomes more selective, lending standards tighten, investment slows, and investors begin placing greater emphasis on resilience instead of aggressive growth. These transitions often happen gradually before becoming visible in economic statistics. History repeatedly demonstrates that major economic transformations are rarely linear. Every decade introduces new challenges. Technological innovation changes productivity. Demographic trends reshape labor markets. Governments modify fiscal priorities. International trade relationships evolve. Energy markets transform. Geopolitical developments alter investment strategies. Each of these factors contributes to an ongoing process of financial realignment. Attempting to forecast every short-term market fluctuation during these transitions is often less productive than understanding the broader direction which the system is evolving. One of the greatest advantages an investor can develop is patience. Patience is not an activity. It is the discipline to avoid confusing volatility with permanent change. Markets naturally experience periods of optimism and pessimism, but long-term value is generally created by maintaining perspective while others become distracted by temporary noise. Successful investing also requires accepting uncertainty. There will always be unexpected developments that influence markets. Economic forecasts will occasionally prove inaccurate, political events will surprise investors, financial conditions will shift in ways that few anticipate. Rather than relying upon perfect predictions, resilient investment strategies acknowledge uncertainty and prepare for multiple possible outcomes. This approach places greater emphasis on diversification, balance, and disciplined risk management than on chasing the latest trend. Strong portfolios are built to withstand changing economic environments instead of depending upon a single forecast becoming reality. Another important consideration is the distinction between speculation and investment. Speculation often focuses on what prices might do next week or next month. Investment focuses on understanding the long-term drivers of value creation and capital preservation. That difference may appear subtle, but over decades it produces dramatically different results. The financial world rewards disciplined thinking far more consistently than emotional decision-making. Investors who remain focused on long-term structural developments are less likely to become distracted by sensational headlines or temporary market volatility. They recognize that cycles are inevitable, corrections are normal, and uncertainty is a permanent feature of investing rather than an exception. Ultimately, the biggest opportunities emerge from recognizing change before it becomes conventional wisdom. Structural shifts within the global financial system develop slowly, often beneath the surface of daily market activity. By the time those changes dominate newspaper headlines or television discussions, institutions have frequently been adjusting their strategies for months or even years. Long-term success comes from understanding these underlying dynamics rather than attempting to react to every short-term fluctuation. Financial markets will always experience periods of excitement and fear, but the enduring drivers of wealth remain remarkably consistent. Disciplined capital allocation, prudent risk management, patience, adaptability, and a clear understanding that lasting financial trends are shaped by structural economic forces, not by the noise of any single trading day. One of the most common mistakes investors make is believing that successful investing depends on accurately predicting the future. Every year, thousands of forecasts attempt to identify where markets will go, where interest rates will settle, which sectors will outperform, or what the next major economic event will be. Some of those predictions will inevitably be correct, but often by coincidence rather than consistent insight. Building long-term wealth has never depended on perfect forecasting. It is dependent on preparation, discipline, and the ability to manage uncertainty. Financial markets are inherently unpredictable in the short run. Unexpected geopolitical events, policy changes, technological breakthroughs, natural disasters, and shifts in consumer behavior can alter market sentiment almost overnight. No investor, institution, or economist can anticipate every variable. Accepting this reality is not a sign of weakness. It is the foundation of sound investment thinking. Preparation begins with recognizing that uncertainty is permanent. Economic cycles expand and contract, credit conditions tighten and loosen, businesses experience periods of rapid growth followed by slower expansion, markets alternate between optimism and caution. These cycles have repeated throughout modern financial history, and there is little reason to believe they will disappear. Investors who acknowledge this pattern are far better positioned than those who assume today's conditions will continue indefinitely. The purpose of investing should not simply be to maximize returns during favorable environments. It should also be to preserve financial strength during periods of stress. Capital that survives difficult markets has the opportunity to benefit when conditions improve. Investors who become overextended during good times often discover that they have fewer options when volatility returns. Risk management, therefore, becomes one of the most valuable disciplines in investing, yet risk is frequently misunderstood. Many people equate risk with temporary price declines. In reality, the greater risk often comes from excessive concentration, excessive leverage, poor liquidity, or decisions driven by emotion rather than analysis. A temporary decline in asset prices may be uncomfortable, but permanent losses usually result from failing to prepare for changing economic conditions. Diversification remains one of the simplest and most effective forms of preparation. Snorts, different assets respond differently to inflation, economic growth, interest rate environments, and financial stress. No single investment consistently performs best under every circumstance. A well-balanced portfolio recognizes that uncertainty cannot be eliminated, but it can be managed through thoughtful allocation and prudent decision-making. Patience is equally important. Markets rarely reward investors who constantly react to every headline. Financial news is designed to create urgency because urgency attracts attention. Every day presents a new reason to believe immediate action is necessary. However, history repeatedly demonstrates that disciplined investors who remain focused on long-term objectives often achieve stronger outcomes than those who frequently adjust their strategies in response to short-term market movements. Compounding illustrates this principle more effectively than almost any other concept in finance. Wealth is typically built gradually through years of consistent decision-making rather than through a handful of spectacular trades. Small advantages repeated over long periods produce extraordinary results. Conversely, a series of emotional decisions made during periods of uncertainty can significantly reduce long-term returns. Preparation also requires maintaining adequate financial flexibility. Investors who preserve liquidity and avoid excessive debt are generally better equipped to respond when opportunities emerge. Market dislocations often create attractive valuations, but only those with sufficient financial resilience are able to take advantage of them. Preparation, therefore, provides not only protection against downside risk, but also the ability to capitalize on future opportunities. Another important element of preparation is maintaining realistic expectations. Financial markets do not move in straight lines. Strong years are often followed by weaker ones. Periods of exceptional optimism are frequently balanced by periods of correction and caution. Investors who understand this are less likely to abandon sound strategies simply because markets experience temporary setbacks. Institutional investors often emphasize process over prediction for precisely this reason. While forecasts may inform decision-making, they rarely determine investment strategy on their own. Instead, successful institutions build frameworks capable of adapting to multiple economic outcomes. They recognize that flexibility, resilience, and disciplined execution create greater long-term value than relying upon a single economic forecast. The broader global economy continues evolving through technological innovation, demographic changes, shifting trade relationships, fiscal policy adjustments, and changing patterns of capital allocation. These developments create both opportunities and challenges, but they also reinforce an important lesson. Economic systems are dynamic. Investors who prepare for change are generally better positioned than those who expect stability to continue indefinitely. Confidence also plays a significant role in financial markets. During periods of optimism, investors often underestimate risk. During periods of uncertainty, they frequently overestimate it. Preparation helps reduce the influence of these emotional extremes by establishing a clear investment framework before emotions begin driving decisions. Having a disciplined plan makes it easier to remain rational when markets become volatile. Long-term investing ultimately reflects a mindset rather than a forecast.